trying to bring a good opportunity to the district to refinance some existing bonds. This are the 2005 bond series. This is money that was approved by the voters back in 2005. Since then, if you are keeping up with interest rates have been decreasing. At one time, they were at historically low rates. Although I see that they are moving up a little bit at a time, the rates are still low enough for us to consider the possibility of refinancing existing bonds. Now, that's very important. This is not that we're going to go out and get new bonds per se. What we're going to be doing is taking the existing bond debt that we have and going out and searching for a lower interest rate that in turn will save some money in interest rates. Now, you have to keep in mind that on most districts, and I think this is pretty close to the percentage, we have a 70-30%. In other words, the state pays for 70% of the bond payment, while the school district pays for about 30%. So therefore, any savings that we receive from issuing bonds or refinancing bonds is split in the same proportion, 70-30. So at this time, I'm going to ask Mr. Tom Lawrence from the Lawrence Financial Consulting Group, which is our financial advisor, to come and do a presentation, show the benefits, explain to the board what are the parameters or the criteria that we will use to proceed with this refinancing of bonds if certain things transpire. So at this time, Mr. Lawrence.
Thank you, Mr. Garcia. President, members of the board, my name is Tom Lawrence. Should I step up?
Yes.
My name is Tom Lawrence. I've been the district's financial advisor for many years and worked with Florence on a number of financings over the years, including both new money bonds that were voter approved, as well as refinancing bonds or refunding bonds where we can get lower rates, and this is one of those. We are actually, in fact, Mr. Garcia pretty much did the presentation. There's not a whole lot more to add other than I do have some numbers, preliminary numbers to show you that are in your board packet. I have a cover that looks like this, and I wanted to go over those with you. As Mr. Garcia pointed out, we are doing what's called a delegated pricing order. We're getting approval in advance of actually going out and doing the bond issue, but we cannot complete the bond issue unless we meet parameters that are in tonight's order, and a pricing officer designated by the board, which would be Mr. Garcia, would have to sign off on a pricing certificate before we could actually finalize the pricing of the refunding bonds. This is a very common way to do refunding bonds. It's authorized under Texas law and has been now for about 10 years. And it's where you get approval up front, and then you're able to do it when the timing is right for the savings. And secondly, we cannot proceed under federal tax law until middle of October. We're getting this done in advance so we don't have to come back and bother the board again, but we're ready. We'll have all the paperwork ready, and we're going to pick a day when the market looks good in middle to late October, because we are not allowed under federal tax law to actually close the bond issue until we're within 90 days of the optional redemption date for the 2005 bonds. They are optionally redeemable at your option February 15th, 2015. Federal tax law does not let us close a refunding of those until we're within 90 days. So that would be November 15th. And so we would do the pricing in mid-October or later and close in mid-November or later. That's basically to comply with federal tax law.
Would y'all come back before the board, before y'all seal the deal, or
once we approve it tonight, we would not have to come back to the board. Now that gets into the parameters. One of the parameters is we have 6 months to get this done. If we don't get it done we don't price the bonds within 6 months, then we would have to come back to the board again. But this would allow us to proceed with a sign off on the parameters tonight, and also with Mr. Garcia's sign off on the pricing certificate in October. Then we would be done. The key parameters are that we're not stretching the debt service out. we're basically just doing side by side, we're basically refinancing what matures in 2033, and we're not changing it. It's still gonna mature in 2033, but with lower payments that you'll see we're trying to achieve in the numbers for you. The traditional customary threshold for doing these refunding bonds is 3% present value savings, meaning if you are refunding, say, $10 million of bonds, you want to save on a present value basis 3% of that, or $300,000. If you can get over that, you proceed. If you don't, generally you don't proceed unless you have other reasons to do it, like restructuring. In your case, if you will open up to the first page of numbers, the savings based on current interest rates are more than triple the threshold. And you'll see that number down below. If you look towards the bottom of the page, it says net PV benefit. We're refunding $7.9 million worth of principal, and the savings are over 10%. And that number is right above it. It's as if someone were to walk into the district and hand you a check for $807,000 today. Now, this is all debt service. It's not operating money. It's on your INS side. It's not more operating funds. It's basically giving you some relief and giving the state some relief on interest payments. So the stream of savings over time are up above in the final column, and you'll see those add up to over $1 million over the next a little less than 20 years. We always present value that to look at it. What does that $1 million mean? Well, it's not exactly $1 million in today's dollars because of inflation. So we present value it back. And that's how you get the $800,000 figure. Basically, that stream of $1 million is worth $800,000 in today's dollars. Now, we don't know, as Mr. Garcia alluded to, interest rates change every day. We don't know where interest rates are going to be in mid-October. We tend to think the Federal Reserve is trying to keep rates down until the middle of next year. We tend to think interest rates are going to behave reasonably within a range. We don't know where in the range it'll be, but we're basically at the mercy of the bond market. But we're going to be ready with your approval tonight. We'll be ready to jump on it and take advantage of the lowest possible rates we can get out there.
And once we take advantage of those rates, is that like a fixed rate?
Yes,
Or does it still
it's fixed.
fluctuate?
No, these are fixed rates that you have now. We would be getting fixed rates. We will also be applying for the permanent school fund guarantee, which means bonds would be rated AAA with TDA's approval of the PSF application. That costs $1,500. It's probably the best guarantee at the lowest price you could possibly get for a guarantee of a bond payment in the United States, the Texas Permanent School Fund, that AAA rating.
Sir, what are the costs and fees associated with refinancing?
If you open up to, let's see, the very last, actually page 5, is the sources and uses of funds, and the costs are all built in. That 10% PV savings is net of the costs. The costs are built into the bond issue. The district does not pay anything out of pocket. The cost of issuance are estimated to be a little over 1%. Let's see, if you go with the total issue price of the bonds, which would be $8.2 million, and the costs are about $100,000, it's about 1.2% issuance cost, and then we would have an underwriter's discount. You can see those under uses of funds. And those are just estimates. I imagine that the costs will be lower than that, but I try to keep the costs a little higher when I present, and the savings may be a little bit lower than we could achieve at that time. It gives us a little bit of cushion. Nobody wants to be disappointed when we finally get this done, but we don't know if we're going to come back with 9% or 11% or 12%, or we just don't know. But whatever we come back with, Mr. Garcia is going to have to sign off on it, and we're not going to want to do it. If we were looking at 3%, we would prefer not to proceed. We'd rather wait. And the reason is, even though 3% is traditional, I think because of the fact that only 30% of the savings would go to the district, we'd probably have more of an incentive to wait until we can get the savings back up. But again, I think if we do this within the next couple of months, I think we're going to be in good shape. I think if we waited into 2015, I think we might be taking a little bit of a chance on interest rate, more of a chance that they're going to be going up.
So how often often can you refinance your bond?
It's an excellent question. We are not refinancing new money bonds. The 2005 bonds were also refinancing bonds. They refinanced new money bonds. And typically, when you issue any bonds in the public market, the investors want 10-year, what's called 10-year call protection, meaning for the first 10 years, they cannot be redeemed out, okay? The 2005 bonds are not callable until 2015. With a refunding of new money bonds, you can refinance them at any time prior to that call date. You don't have that 90-day window. You can do it 2 years in advance. You can do it 3 years in advance. Once you are refunding a refunding, you can't advance refund it. You have to wait till you get in that 90-day window. Once you're in the 90-day window, you can refinance as often as those bonds are out there. So these are 2033 bonds. If we get this done in October, November, they would be callable in 2024. So within 90 days of the 2024 call date, we could actually refinance what's left out to 2033 again. But you have to, since they're refinancing of a refinancing, inside that 90-day window.
So the 2005 bond series have already been refinanced?
Though that is a refinancing issue itself. The original bonds were issued in 1995, I believe, or 90. It may have been later than that. We didn't have to wait to get to the 90-day window. I would have to look at my records, and I could actually turn my computer on if you wanted to know. I don't think it was 95. I think it was a late 90s, like a 98 issue. And we refinanced it in advance of the call date, more than 90 days, like a couple of years in advance.
You know what the bonds were for, the initial bonds?
If I turn my computer on, I would know.
Was it like for construction, it had to be for construction?
Oh, yeah, definitely, construction, absolutely. They were permanent school fund guaranteed new construction bonds. I just can't remember the specific facilities.
Followed by
You have two bond issues right now, the 01s and the 01As. They're about to fall off. I think the last payments are in this next year. Then you have the 5s, the 6s, and the 8s. And the 5s, 6s, and 8s are all refunding bonds. You haven't done any new money bonds for quite a while, Florence, as I believe. Those may have been 2002. The athletic field, is that what you're thinking? That may have been the 01 or
97A.
I think it was the 01As.
The 97A.
Yeah, but we refinanced. See, I think the ones that were issued in 02 or 01A, it was towards the end of 2001. That was the last new money bond issue, but we refinanced those through either the 6 or the 2008. Anyway.
Three things happened years after. There was the real entry, and then there was the
The athletic field. You have about 20 million outstanding. This refunding would refinance more than a third of your outstanding debt, approximately 8 million out of 20.
Sir, and are we looking to refinance with the same lender, or are we looking to like broker out and see a lower?
This will be, it's too big and too long term to do it privately. I don't have a problem doing private transactions with a single lender, but this one's too big and too long for private lenders generally. You could probably find a lender to do it, but their rates aren't gonna be competitive enough. So what we do is we get involved with 1 or 2 underwriters to come in, and they're on the other side of the transaction. I'm on your side of the transaction. I represent your interest. But the underwriter would be taking on basically the acquisition of the bonds for distribution to all kinds of lenders or investors, mutual funds, banks, insurance companies, anybody that would be interested. And they're parceled out. If you would take a look, I'll show you how it's marketed. If you do it with a bank, you're going to get a single interest rate for the whole thing. show you how, at least at the time I ran these numbers, how this bond issue looks. It's not just really one big bond. It's multiple bonds. It's about 19 of them, each with its own coupon, its own principal amount, and it's sold to investors at various prices. They don't necessarily pay the face amount. They'll pay over the face amount. In this market, oftentimes they're paying a premium. And you see the coupon, that's gonna be the coupon on the face of the bond. The maturity value is gonna be what you pay back at maturity. But those coupons are not real life interest rates based on the current market. The ones that are in the yield column are. That's what rates are doing right now. A short-term rate is at a 0.45. The longer-term rate is at a 3.4. The investors would be paying you over par in this current market situation. They would be paying you more than the face amount of your bonds, quite a bit more, just because that's the way the market is right now. But when you go all the way down to the very bottom of the page, that's the true interest cost calculation for the entire issue at 2.98 at the time I ran these numbers. You would not get a 2.98 from a private lender. We'd be looking at, my guess is 3.5%, something like that. And it would come at a lower cost. We wouldn't have the underwriter's discount. Issuance cost might be a little lower. But believe me, that difference in interest rate over the next 19 years makes a big difference. They'll save a lot more money going into the public market. And the average coupon on the bonds to be refunded is the page before, I believe, almost 4.4% is what you're paying right now. Not a terribly high rate, but if we can get it down to 3% or thereabouts, you're going to save a lot of money over 19 years.
But these are the rates that they're going at right now, it's not like doing a buy down, right?
No, it's not a buy date. It's basically the old bonds will be taken out on February 15th. They'll disappear from existence. They'll be called. We aren't defeasing them with an escrow fund that is going to be out there for the next couple of years. They're going to actually be paid off, and this will be in its place. They'll stop paying the 05s and they'll start paying the 14s. And the savings are, looking to be over 50,000 a year. 30%, that's about 15,000 a year for the benefit of the district. 15 is 15 so thousand. Are there any other questions?
Just can you give us a rundown real quick, the parameters, whether it's gonna be a go or not?
The savings parameter in the order is the standard 3%. If you want to raise that, we can raise that right here and now to a higher level, or we can let Mr. Garcia decide if we're in the 7 or 8% range, do we go forward or not? If rates have gone up between now and October. You can set a higher threshold. We usually start with 3% and we let you decide if you want a higher threshold, and basically you will not settle for, I can easily see putting 5 or 6% in there tonight. We'll just change it.
What are the risks with refinancing the 2005 series?
The risks, I don't see any at all.
It's not costing us anything, we're gonna
No.
actually save money.
Yes, you're gonna save, the issuance costs are built in, that these savings are net of those costs.
I think where the risk would be if we say, if we started at 3%, and then I guess the costs are too much, goes over. There's no way it's gonna go over 3% of the savings.
That's based on the issuance of the cost is based on the
They're
amount of
pretty-
money.
They're standard,
Right.
pretty much standard fees and costs, and I'm on the side of keeping the costs low. The costs on the transactions I work on are noticeably lower than you'll see in a lot of others. I do work to keep the costs low. They're in line or lower than you'll see on other bond transactions. And you're not gonna see you're not gonna see I can see your concern. If we leave it at 3%, then you can raise the issuance costs and drive the savings down. That won't happen. That's simply not in the cards. If if any, there's so much transparency in these transactions now in the marketplace, and more now than ever. The SEC and the MSRB, the federal regulatory organizations that govern our industry, there's all kinds of visibility in our transactions nowadays. Ever since the Dodd-Frank Act in 2010, following the financial meltdown, everything is an open book everywhere. All of the figures are out there for everybody. If we were to charge excessive costs, it would make the news, and it wouldn't be a good thing. Instead, you'd rather be known for doing the right thing by the issuer, and that's what we're doing and have done for many years.
Mr. Rocio, will refinancing the 2005 series help with our INS M&O problem?
It'll help with the INS side.
Correct.
It's gonna save you a little bit. If it, in fact, that comes in at about 9%, 10%, you're probably looking at about half a penny on the tax rate, which is a big help, although it seems like it's not. One of the things that I would recommend to the board would be increasing the parameters to maybe 6%,
Okay.
which means that if the savings is not more than 6%, then we cannot move forward. Now, are you going to designate me as the pricing officer? Is that correct?
Yeah.
That's correct. So if I don't see what I'm gonna be looking at, that we receive at least a 9% on top. So even if the board tonight says, okay, 6%, you have the green light, we'll leave it up to you. If I don't see at least a 9% improvement on our savings, then I'm gonna just say, you know what, let's just hold off, see if the market gets better or whatever. But also, I have to keep in mind the interest rates and how they're going. Because if all of a sudden something is happening in the bond market and we're losing ground quickly, and selling at 6% is a good thing, or at 7% is a good thing, then I will take advantage of that. But I'm going to try, if the board approves, to maximize the maximum that we can. When you set the parameters, you're gonna set the floor, looking, the minimum that we will accept is a 6% savings.
Right.
If not, we just can't.
We just hold off. And the other thing to keep in mind is, as mentioned earlier, this does help TEA, it helps school funding in general. The more the districts do things like this that are property poor, where they're not getting as much of the benefit as the state, or the money that they're not spending on debt service finds its way to other uses for other new money bonds and operations, tier 2 funding. If they're spending it on excessive interest, it's not helping anybody. So I always encourage districts, if the savings are reasonable, but more so to the state and the district, it still works to your ultimate benefit collectively with all the other districts in the state.
Sir, and how is our payment history, does that have a factor on the interest rate as well, or?
Yeah, I mean, we will apply for a credit rating, and we'll get your underlying credit rating updated, and then we'll get the PSF rating. Your underlying rating does have an impact in this day and age. It's not, let's say if you're in an A-rated district versus a triple B rated district, you'll see ever so slight difference in the rates. There is a little bit difference in the rates, even though they're AAA. Investors will take note. Now, triple B is an investment grade rating, so is an A. It goes triple B, A, double A, triple A. Those 4 categories are investment grade.
But depending on what kind of paper you are, either your A or your B, that determines the interest rate as well. What category?
In general, yes, that does determine it, but the biggest factor for your interest rates is going to be the AAA PSF.
And that's one thing, just to give you a little bit of history, because we went out for time warrants, and that was based on the actual credit rating or credit worthiness of the district.
Right.
Although this has a small impact on it, remember that this is bonds that are backed up by the state of Texas under the permanent school fund. So the state is pledging